Financial Matters.
In studio is Dr. Frank Magwegwe, Head of Financial Wellness and Advisory at Nedbank, also a GIBS faculty member who will soon be a professor.
Thank you.
Yeah.
From your mouth to God's ears.
Yes, sir. Let's talk a little.
Good evening, 702 listeners. I'm being started on a good note by Aubrey here. And of course, we mustn't forget you wonderful Cape Talk listeners. Tax-free savings accounts.
Absolutely. Doc, I do want to talk about that.
Yes.
Tax-free savings accounts. I've been having a lot of conversations around tax with various people. Sorry, am I away from the mic? Sorry. Let me get closer to the mic. I don't want to infect the mic. Anyway, but I've been having a lot of conversation about tax lately.
Yes.
About the message that was delivered by the Minister of Finance just a few days ago, where there were some changes in the tax regime. We touched on that last week, you and I.
Yeah.
But I'm beginning to sense that we need to be a lot more tax savvy.
Absolutely, bro.
I'm beginning to feel like we need to understand that we've got to be more active in the process of understanding the tax regime of this country rather than passive.
Absolutely.
And I think that's part of the reason why we're having this conversation.
Because we listen to our listeners,
right,
and they've said to us, we love what you talk about when you tell us how to think about money.
Right.
What Stanley Beckett, part of what he's going to talk about, the money mindset. But they've also said to us, also talk about products.
Yes.
How they work.
Yes.
And part of what you are doing is explaining this product that really needs us to actively understand the tax system in the country. Not only understand, Aubrey, and benefit from it. And benefit from it.
So let's talk about those tax products.
100%.
But perhaps let's talk about them from the point of view that says, what inspires their existence?
100%. And I also wanted to start there. And I wanted to start with a question to you, Aubrey, that says, and of course our listeners can do the same. When you hear this expression or these words, tax-free savings accounts, and I want you to focus on the tax-free. What comes to mind for you? Tax-free savings accounts. That's what they're generally called.
So the first thing that comes to me is the realization that even your savings can be taxed.
Amen.
Right?
That's exactly what I was looking for.
Because many of us, at least myself, thought that, tax... I mean, your savings, you put it in a savings account, or you put it on the mattress. No SARS is going to be able to. It appears, based on what you're asking,
correct,
that even your savings can be taxed. Yeah,
and that's a wonderful. And what I've just done, I often do that when I'm teaching at GIBS or some of the work I do at Nedbank, to understand things sometimes, Aubrey, it's just saying, but tax free. It means there are other savings that they tax me.
Yes.
So what we're saying, listeners, this evening is the idea that the arm of the tax man reaches far.
Yeah.
When you are investing, we unpacked
the law sometimes.
Exactly. Yeah. We unpacked last week. What is savings? What is investment?
Yeah.
And now what you are saying, even that money you are putting aside, you make or earn interest on it. We'll talk a little bit about the exemption, but SARS is going to say, I want my portion. You invest in a share. The share price goes up. SARS says that is what I call capital gains.
Yeah.
I want my share.
Right.
You invest I want my fair share or my part of it. You invest and your Sasol, your Standard Bank, your Nedbank, your Absa shares go up, your ShopRite, your Pick and Pay, any share that's listed on the exchange, your Anglo-American.
Yeah.
What does I say? No, you earn the dividend. I want dividends tax.
I want something.
So it is important, as you said in the intro, Aubrey, to say we need to understand the role that tax plays in investment, and hence the system of savings in South Africa through SARS introduced this product, tax-free savings account. In fact, right now, March 2023, Aubrey, tax-free savings accounts are celebrating 8 years.
Yes.
They only started 1 March 2015. It's not an old product. To encourage individuals to save in a product that says, SARS, everything I get in this product is mine. You can't touch it. That's what we mean by tax-free savings. Whether it's interest that you earned, SARS won't touch it. Whether it's appreciation of your shares, SARS won't touch it. Whether it's dividend, and exactly the name tries to describe that. Tax, but there's a catch to it.
Right.
There's a catch.
There's always a catch, right?
Yeah, there's a limit.
Right.
In a given year, currently, you can only put 3,000 rand a month or 36,000 a year. Finish and clear. That's the only limit that's allowed. The moment you go above that, there's actually penalties. So SARS is saying, no, I can only benefit you with this wonderful product to the tune of 36,000 a year or a lifetime 500,000. That is it. So you are only allowed in the current dispensation in South Africa, Bra Aubrey, to put 36,000 a year or a total in your lifetime of 500,000.
Why, Doc?
Because if they allow you to put more money above the 500K or the 36, SARS is losing money in tax. The tax on capital gains, the tax on dividends, the tax on interest. So it's a special product, but it's got limitations around it.
Right.
Similarly, probably remember with retirement that we can invest or put aside for retirement up to 27.5%. That's it. Anything else you put aside for retirement, I want my portion of it. Because the government doesn't make money. They want to make money through, or they make most of their money, rather, let me rephrase, through collection of taxes, VAT, income tax, company tax, for example.
But I suppose my question is more about why 3,000 a month? Why not 5,000 or 2,000 rand? Is there a specific rationale behind that number, 3,000?
So they would have crunched the numbers and said, if we allow it to be, let's say, 50,000, we cannot afford to lose. It actually started on 1 March 2015. It was only 30,000.
Right.
So they crunched the numbers and said, we are only prepared to give South Africans this exemption to invest without us touching any of the return, whether it's interest, whether it's dividends, or whether it's your share price going up. We only started 30, and then they moved to 33 a couple of years later, and they moved to 30. So it's effectively, SARS says, I am not prepared to not earn or not get my tax on anything above 500,000 in a lifetime or 36,000 a year.
Talk to me about what is the benefit. I mean, I hear tax-free savings. I hear that. What is the benefit? So you'll probably be able to say, Aubrey, you're getting 33,000 rands and you're not getting taxed. But it's 33,000 rands that I've worked for.
Correct.
Again, I suppose my very suspicious mind these days is saying, I'm feeling like I'm being gaslit again. To be thankful for something that I created, and I must be thankful to somebody else for creating the impression that they're helping me out. Well, what is the real benefit to me if I've put away 36,000 rand that's not going to be taxed?
Right.
Help me answer that question a little bit better.
It's a wonderful question. So before I answer that question, let me do a bit of an intro on the role, just very briefly, of savings. Why do we need, you and me, Bra Aubrey, to put money aside? Whether we give that money to a bank, let's take a simple one.
Right.
We talked about savings, so there's no lot of risk associated with it. What is happening when you give your 1,000 rand to a bank? To a Nedbank, to an ABSA, to a Capitec. What is happening? What is happening is the following. Forget about the interest you're going to get. I'm trying to get our 702 listeners a simple way to understand why that is important for our economy to grow.
Right.
When we give 1,000 rand, we put it in our savings account. We put it in a 32-day deposit. What effectively is happening is our bank, wherever you put it, takes that short-term deposit, because you can go and get the money tomorrow or next month. And then they give it to an entrepreneur who want to start a business. That's a long term, right? So banks convert short-term deposit and give the money needed by entrepreneurs, as an example, to create jobs by starting businesses, right? So countries with a high savings rate, in other words, that they've got individuals who put quite a bit of their money aside, they have high growth rate. Why? In general. Doesn't always work like that, but in general. Why? Because there's this big pool of money available to people who want to take risk, people who want to start businesses. Banks give them that money, and if it all goes well, like we spoke last week of the good example, the discoveries that were started many years ago by the Adrian Goes, the people who started Capitec, for example, right? So we need savings. Now, with that, understand that savings is important for our economy to grow. We then come back to, I see. What is the good doctor saying? I'm saying, SARS is saying, we want to incentivize South Africans who don't typically save enough. We've got one of the lowest savings rates in the world. We want to say 36,000 a year. Maybe it will get Bra Aubrey, it will get Frank. In fact, it will get Owen Molepo. Who's Owen Molepo? Is our avid listener. He works at My Way. I promise, Bra Aubrey.
Hello, Owen.
I'm going to do a shout out.
Nice.
Owen.
Yes.
You see, you can trust me.
Yes.
Hello.
Yes.
Good evening. I hope you are listening. You talk to me let's briefly digress. We're going to come back. He called me. He works at My Way. You know My Way, talking about insurance. And 30 seconds into conversation, he says, may I ask you, are you the guy on 702 with Bra Aubrey? So, Bra Aubrey, you have made me famous. I'm a mini celebrity.
You have made yourself famous.
I'm a mini celebrity. But Chris, it's the Aubrey Masango show. He's the main act. I'm his sidekick. So, hello, Owen Molepo. We're talking about savings this evening. And we are saying, SARS is saying they want to get Owen, who works at My Way, to put money aside. Maybe the idea of you won't be taxed, Owen, it might be that nudge he needs. When he puts his money, even if it's a fixed rate account at a bank, that allows the bank to take part of that, give it to an entrepreneur to start a business, give it to companies, and therefore, SARS is saying we're encouraging people, that's the rationale, who would not normally put money aside because they know they're going to be taxed, maybe to do that. That's the rationale. So, 2015, SARS introduces this product.
What I'm hearing is that, and very often I speak whenever we're having conversations about entrepreneurship. I have a lot of young people specifically who call in and say, but you know, I'm not getting the assistance from banks. Banks are not investing in startups like mine and so forth.
Correct.
And what I'm beginning to pick up from what you're saying there, Doc, is that if perhaps we have more savings, then perhaps there'll be an incentive for banks to start investing in entrepreneurial startups.
That's part of the reason, because I need the risk appetite to give entrepreneurs money, but I need a large deposit base that allows me to take the money, I price it, in other words, I charge an interest rate that's reasonable, and off we go in terms to get these young people to hire one or two people in their businesses, and we attack the problem of unemployment. So it's really an incentive to get South Africa going by increasing the pool of savings that we have.
Give us a call, 011-883-0702. Any questions for the good doctor about your savings, tax-free savings, opportunities and products that are out there? Please give us a call on 011-883-0702 or 021-446-0567. Doc, is it possible to make a lump sum per payment of 500,000 rands to say that this is my lifetime savings amount that I'm putting away? Will I earn the interest on that 500,000 rands? Can I put away the 36,000 rands per annum? How does it work?
Lovely. So we're getting into the mechanics of the product. So a couple of things. You're right, Bra Aubrey. If you have the 500,000 lifetime, boom, you put it in, and then you can't invest any more into this. It's tracked. Banks have to make sure that you don't put any cent more than your lifetime. So you can put it straight away, or you can put it in 3,000 a month for a limit of 36,000 a year. Where does the money go? So you can put it as a lump sum, you can put it monthly. And of course, you can put 1,000. We're just talking the maximum is 3,702, listener. Please don't say, they are saying I need 3,000 to put in a tax-free saving. We're not saying that. You can put 500 rand a month. The maximum is 3,000.
Right.
Where does it go? It can go into fixed deposits. So banks are allowed to create tax-free savings accounts that you can put money in. Insurance companies can also do the same.
Okay.
And the underlying can be a unit trust. It can even be a share. We spoke about investing last week. So depending on your risk tolerance, you are in the driving seat, 702 listener.
Right.
What is the underlying product where my money is going? Either as a lump sum or as a recurring every month. You choose. Either it goes to a bank type product where I earn interest, or I want to take some risk. I want to grow this money.
Yes.
And so you can put it in a product that invests underlying in share. Even in property, Bra Aubrey.
Wow.
The underlying can even be property.
Right.
It's up to you as the investor.
Oh, is it up to me or is it up to the bank that is holding my 3,000 rands a month?
So you choose the product at the bank, right?
Yes.
And by so doing, we say, I want you to put my 3,000 monthly in a fixed deposit. I just earn interest. Or I'm choosing this product where you put it for me in shares, as an example.
Yes.
Or I'm choosing this product where you put it for me in property, for example.
So the choice of product that you take from the financial institution you choose will determine what that money will be invested in.
Correct.
Okay.
And you need to work with a financial planner.
Right.
If you don't have the expertise to say, I want to open a tax-free savings account. If I want to go beyond just putting it and earning interest in a money market or fixed deposit type of account, what risk am I prepared to take?
Right. I got a number of calls coming through on 011-883-0702. It's a big topic.
Yeah.
Indeed, if you've got any questions around tax-free savings accounts or products out there, how it all works, please give us a call. We'd love to take your calls. Lebo is in Pretoria. Good evening to you, Lebo. Hello, Lebo.
Hello?
Yeah, go ahead, Lebo. What's on your mind?
Aubrey, I was thinking, and when it comes to salary, right? You earn your salary, then you pay a tax, pay as you earn.
Yeah.
Supposing you earn about 50,000, then you earn, then you take home 35,000. You choose and decide that you're going to save 7,000 a month.
Yeah.
I want to know that if you save that money at the end of 5 years, would the government have access to that money?
The money you are putting in a tax-free savings account, right? That's your question. Would they have access to it?
Yes.
So they would know about it, but they wouldn't have access to it, because the way the product was introduced was to make sure that the systems of banks, of insurance companies are able to track, even if you have, Bra Aubrey, in more than one bank.
Yeah.
Even if you have part of it in a bank, part of it in an insurer, they were required to develop that track that this is what Frank has, this is what Bra Aubrey has. So they know about it, but they cannot touch. That product is safe from tax. So whatever growth or returns or interest you have, they cannot touch it. SARS will know about it, but it's set up in such a way that they cannot go and have tax levied on it. A different example, if you have money in an unit trust at an insurer or at a bank, you don't even need, Bra Aubrey, to calculate and hand over the money to SARS. No. The financial services provider has to calculate the tax and they hand it over on your behalf.
All right.
So on that product, no, they can't even do that.
Lebo,
So it's very safe from tax.
What I want to find out,
Yeah.
what I want to find out is, I've already paid my taxes.
Yeah.
I'm deciding to make savings. Why should I be taxed over and above? Because I've already paid my taxes.
Okay, so you're asking a different question. So if I answered the first part, they can't touch your money in a tax-free savings. Your question is, but I have already paid pay as you earn. Listen to its name, pay as you earn. In other words, income tax.
Yeah.
The government has legislation that says over and above income tax, I am also going to, it's in the Income Tax Act, I will also tax interest above a certain level. I will tax appreciation of shares or capital gains. I will tax dividends. That's in the income tax. It's the law. In other words, you can't run away from it.
Lebo, not only that, but you get taxed.
VAT.
VAT, you get taxed on your rates and taxes.
Yes.
So it doesn't stop on pay as you earn alone.
Unfortunately, I am driving and I'm not sure if you guys can still hear me. But I think the message that the government taxes over and above what we have already paid. So why would we have the incentive to save? Because then...
Yes.
But anyway, I have a fundamental issue with the way that system is completely set up.
Lebo in Pretoria, and I think what Lebo is pointing to is the fundamental issue that most of us have about this idea of taxation.
Correct.
That we are taxed at every single step,
And do you know that's part of the war that unions, I'm thinking of COSATU, for example, SAFTU, they have fought for years to say, but people are putting money aside for retirement. And then you give us this threshold that says anything below 500,000, let's say you've got $1 million at retirement. Anything below 500,000, you can get it lump sum, tax-free. Above that, they tax you. And they say, but why? I've been paying tax all along, income tax. And the government just says, no, I have it in the Income Tax Act that says I'm allowed to tax your retirement savings as you exit the fund.
I absolutely understand Lebo's frustration.
So it's the law.
Absolutely. Let's talk to Andrew in Annandale. Hi, Andrew.
It's the law.
Hello, Andrew.
Yes.
Go ahead, Andrew.
Good evening, Andrew.
Hi. I was just thinking that if, like, even SASSA holders and even the siblings of SASSA holders might put in, like, just invest in whatever commodity for maybe like 300 rand a month or something like that. And if there are million of million is contributing, they're making a big impact. So I'm just thinking at the end of the year, things like that, it's about 3.something billion and things like that. And that's where people is going to realize the value of money. And it's also going to contribute to when corruption is happening and all these kinds of things are happening, that it will swing the vote of what is happening in our country. And I've got my money there. And my money is going to make a difference.
Yeah. So if I understand you correctly, Andrew, you are encouraging people to save so that we buffer ourselves from some of those kinds of eventualities that you're referring to.
Yes, like if they hear about corruption and things like that, they can start feeling.
Yeah.
Even if it's 100 rand, it's going to go 1.2 billion.
Yeah.
If they are millionaires. So we should be encouraging that.
Yeah.
Even if it's a minimum.
Yes, absolutely. So Aubrey is also making a point around we need to grow the savings pool in South Africa.
Yes.
So let's encourage people even to put 300 rand aside.
Yeah.
Because that's important for the system at an SA level. To just say we are a nation that's got a higher rate of savings is generally good for our economy. So it's just doing the math and say even 300 rand a month is 3.6 that helps.
I can almost
start
hear
with the little that you have.
I can almost hear somebody saying that, in a perfect world, guys.
Yes.
Andrew, Dr. Frank, in a perfect world.
Yeah.
But in the world that we live in at the moment, it's actually just creating more pots from which to steal.
Yeah.
So the issue is not just the creation of these funds, but to also have the systems that protect them effectively from those grubby hands of thieves. Yeah.
And in fact, that's the journey that the SARS Commissioner, Edward Kisweta, has been on to say, with revelations from state capture and many other shenanigans we pick, that we lose trust in the tax system. Yeah. You say, where does the money go? And so your tax morality becomes challenged, and we get what you are saying, that, well, if I put this 300 or this 500, is it safe from them? Can they just have legislation and they go and take my money?
Yeah.
So that's a big
and that's the sad thing.
Country.
That's the sad thing about institutional corruption.
Correct.
It creates a deficit of trust in all of our institutions.
Yeah.
And that is something that we need to really guard against. Let's talk to Benjamin in Cape Town. Good evening to you, Benjamin.
Evening, sir. How are you doing?
I'm very good, thank you, sir. Go ahead.
$1 million question as an entrepreneur. Is it right for me to think that if I buy properties in that and use that as my retirement or my investment per se? Because it's easy to say, yes, we need to save, but as an entrepreneur, you don't always have that money on the side to be able to put it aside. But as an entrepreneur, you also tell yourself, let me rather invest in assets, and that's in property. So if I have 5 properties in my lifespan and I use that as an offset as my retirement per se, will that work? And my second part of the question is, what is then the best rate in investment that's around nowadays?
Doc?
So I didn't get the second question. Is it still on the line?
Yep.
The second question.
What I'm saying, what is the best or the highest rate return on investment?
Oh, okay, I get you.
Going down?
Perfect. Okay, what a lovely question. So firstly, I just want to say, pat you on the back as an entrepreneur that you are indeed thinking about retirement and the fact that I need to put something aside, but I may not have money. We spoke about investments last week, and you are alerting us to the fact that when you put all your eggs in one basket, when that basket falls, the eggs can all break. What do I mean? If you have 5 properties in retirement, if there is a property bubble and, property is at an all-time low for various reasons, or there's a COVID type, a pandemic, or just interest rates are very high, all those things that affect property prices, it means for you will be hard hit than a person who has some money in shares, some money in property, some money in bonds, who has got, in other words, what we call a diversified portfolio, for his retirement. In other words, he's put his eggs in several baskets. That's the risk that you face. Having said that, it's better to start than to wait until you get to retirement and then you struggle. So if you feel your business is related to property and you kind of know your way around property, it is okay to have such an asset that can give you that peace of mind in retirement. What you would, however, need to know, because we're also talking about tax, rental income is taxed, right? So you need to factor that into account if you're earning rental income. When you sell your second property, your third, your fourth, there's capital gains. In other words, you bought a property for 100,000. It is now worth 300,000. You pay tax on that difference. So you can't really, run away from the tax man. In terms of return, property shares, generally speaking, those have higher risk and so are associated in the long term with higher return. So there are some of the asset classes, as we often call them, that have lots of risk, but they also come with higher returns. Let's make it practical. There's a company called Transaction Capital. What happened yesterday, Aubrey? Their share price fell by 40%. Let's make it a simple example. If it was 100, it fell by 40%, which means it went down to 60 Rand. So share prices can be risky. When news is bad on a company, the same can happen to property.
Prof, yeah, it's happening now.
Yeah, I can see.
It's happening.
Yeah, he says Prof. Instead of saying doctor, he says Prof. Yo, my boss, I hope my boss often tunes in. Professor Morris Mtombeni, the dean at GIBS. Aubrey is already saying I'm a professor, so I must work hard towards it.
To us, you have already prophesied, Prof. Mel X says SA retail bonds are a better option for savings, much better than fixed deposit or money market. Comment on that, Doc.
SA retail, let's tell our good Cape Talk and 702 listeners, what is a retail SA bond? That other innovation from the South African government through the National Treasury, that also says one way that governments raise funding for their projects, they raise money other than through taxes, is to issue bonds. They are instruments, they are basically loans that governments have. Big institutions often buy them, banks buy them, and a number of years ago, individuals like you and me, we got an opportunity to give or to borrow the South African government money through the retail sector. So they've got a good level of interest rates because they have a little bit higher risk than your fixed deposit, as an example. So they are a good investment that exposes you to some level of risk if the SA Inc. Goes bankrupt, but that's highly unlikely because they can always print money. So definitely something I would encourage you to have in your portfolio, as well as money market, and definitely for growth in the long term, you need some shares, you need property. That's why it's important to talk to a credible financial planner to kind of structure that portfolio for you.
Let's talk to Cora in Somerset West. Good evening to you, Cora.
Good evening. I'm an 80-year-old retiree.
Yes.
I was led to believe that I can transfer my tax-free savings. I have subscribed to them since the beginning, from one bank to another.
Mm-hmm.
The Capitec opened the account, and when I tried to transfer the gross amount plus the interest for the last financial year across to Capitec, they only accepted the interest for the last financial year because it was more than the 36,000. Now, at the moment, 258,000 rand, which is my annual investment since beginning, is hanging somewhere in the air. It's supposed to be in the one bank subsistence account, but I've been backing since last Monday. Nobody seems to know whether you can transfer the full amount. Can you perhaps advise me?
So the government is quite strict. I think without more info around the situation, difficult to perhaps answer the question in a way that satisfies you. But you already started answering that question by saying they are quite strict on the 36,000. There is even penalties for you as the investor if you put more than that. And of course, banks, they can also get into trouble by allowing you to either invest more than the 36,000 or more than the 500,000 lifetime. So it sounds like in what you explained about it was more than the 36. It's an issue around you already have contributed your maximum for the year, and therefore there's issues around moving and keeping track of your contributions if the money moves from one bank to the other. But if you want me to help you and maybe investigate it a little bit more, please just go to frankmagwegwe.com, hit the contact me button. You'll get an opportunity to send me an email. Then I can help you by first understanding your specific situation. But it sounds it's around the limits. And thank you for listening to our wonderful show as an 8-year-old retiree. You really warmed my heart.
Absolutely. Let's talk to Josh in Pretoria. Good evening to you, Josh.
Good evening, Aubrey. Good evening, Doc.
Yeah,
Good evening, Josh.
I'm 5-year-old, and my daughter is turning 5.
Your daughter is turning 5.
April,
Okay.
Yes.
Yeah.
I wanted to know, is a tax-free savings a good product to use to save towards her education? I'm talking about the tertiary education one day. I was looking at saving for the next 13 years.
Yeah.
Would it be a best move, a good move?
Wonderful question. So firstly, congratulations. The idea of putting money aside for a 5-year-old is really, really powerful. So that warms my heart. Without a doubt, you can put money aside for yourself or for your daughter into a tax-free savings account. However, there's a bit of a catch that you need just to be aware of. When you put the money for her, you are already using at 5, you are making a decision for her on her lifetime 500,000, or it might be increased over time. So in other words, you have already made the decision that for my daughter, I'm putting the money allowed into a tax-free savings account for her, And, she'll be okay with it when she grows up. In most instances, I'm sure she would be okay with that. So just be aware of that you've made that decision for her already. Then, to your point, if you have put that money aside and now you want to take a little bit to start paying in 13 years' time for tertiary, can you do it? Absolutely. You are allowed to make withdrawals from your tax-free savings account, and so you'll be able to take some money and use it to pay for tertiary education. What you just need to know, though, is that account cannot be used as a transactional account. You can't put stop orders, you can't put debit orders on it, but you certainly can get in touch with your financial services provider and tell them, I need 20,000 to pay for tertiary education from my daughter. That's important. Finally, I think for you, you'd need also to make a decision whether you're putting it in a product that is just earning you interest, so it's kind of fairly safe, or you'd like, because 13 years is a long time, you'd like to take a little bit more risk and grow it, in which case you need a product that has shares as the underlying investment or a unit trust. And you can work with a financial planner if you don't have the expertise to make that decision. But absolutely good plan.
Josh in Pretoria, thanks very much for that call. Mbali on Twitter says, please ask the guest about the projected interest rates that different tax-frees quote. I've noticed that equity-based accounts have a marginally higher rate than bond or money market tax-free accounts.
Lovely question. In fact, it's not even marginally higher. When we are putting it in a bank type of product, you're tax-free, you're probably getting 7-8% sort of current rates now. When we're talking shares, when we're talking bonds, for example, bonds, you're talking a little bit higher. If you're talking shares, you're talking 10, 12, or even 15%, over a longer period, because you're assuming more risk. So really the difference is when you're putting your money in a bank tax-free savings account, you saving, Bra Aubrey, if you go to last week, you're just putting money aside. It's quite safe.
Yeah.
It's only earning interest.
Yeah.
When you put it into a product that has got shares, that has unit trust underlying, that's got property, you are taking risk, and therefore your return can easily be double the one that you are getting in a fixed deposit type. So it's about your risk tolerance.
Sihle, sending appreciations for the doctor's teachings. Lesiba Ledwaba says, good evening, Bra Aubrey and your guest. Insurance companies tell us government employees to put our pension money with them to reduce tax. How true is that?
Absolutely. Wow. That allows me to talk another point, because we would not want to finish our show 702 and Cape Talk listener with having created the impression that the only tax-free product is the tax-free savings account, right? So that is not the case. Already, you have a product that allows you to be tax efficient. It's not tax-free, but it allows you to be tax efficient, and that is the retirement contribution. Because as you are contributing to it, it grows and tax is only levied right at the end. So if you were to ask me, Bra Aubrey, what's the prescription for today? Right? Because we want to give a prescription.
Sure.
I would say,
as we do every week. Yep.
Do not rush into a tax-free savings account. They are wonderful. They've got the tax benefit that we have talked to. Before you maximize your contribution to your retirement savings, if you're in formal employment, your first thing, please, Cape Talk and 702 listener, contribute the maximum that you can to that company retirement savings. If you cannot save in a tax-free saving, once you have done that, it's okay. You're already doing yourself a big favor for retirement. If you are entrepreneur, you're self-employed, contribute the maximum you can to a retirement annuity, because it's got the same tax benefit, before you go and invest in a tax-free savings account.
Inkunzi Mnyama says,
We are tuned
in as always, listening attentively and taking notes.
Yeah.
My partner has been won over to this show. She is now Dr. Magwegwe fan. Our Wednesday nights are for this show, whether there is load shedding or not.
My
says
goodness,
Inkunzi
thank
Mnyama
you.
and his partner.
And Inkunzi Mnyama, you have to thank the person the show is named after. The Aubrey Masango show. So I must say, as what Mampincha would say, thank you for featuring me. Bra Aubrey, I am the sidekick. Hey, a man who's paid for talking. He's stamped a little bit.
Let me tell you what Thinking About Thinking says onto it. It says, good evening, Aubrey and the good doctor.
Yeah.
On the discussion of tax-free SA or savings accounts.
That's right.
What does a lifetime of 500,000 rands mean? Is that you can save up to 500,000 rands only, or does it mean you can only draw interest up to 500,000?
Lovely question. Apologies, I didn't make it clear there. It means in your lifetime, the maximum, as we see today on 15 March 2023, the limit is 500,000. Once we have invested 500,000 today in South Africa in a tax-free savings account, not a cent more.
All right. Doc, and then final question. Somebody asking about a state bank. I think Tonic says, would a state bank not help to cut some of the costs and therefore put more money in the citizens' pockets? I mean, would a state bank be subject to different rules?
Not necessarily. So, in fact, tax-free savings accounts, by the way, you can even get them at the post office savings. Post bank can also offer that. Not necessarily. However, you introduce us to one of the topics we need to investigate, Bra Aubrey.
Right.
So we've talked about tax and benefiting from tax-free savings account, putting your money in a retirement at your work or in a retirement annuity. That's all being tax savvy, right?
Right.
We also need to talk about one of the big things that chows your money when you are putting it aside to grow. And what is that? It's fees, it's costs. It's not for free to give your money to a bank. It's not for free to give it to an asset manager. We need to do that to just help people understand what might sound like, it's just 20 Rand admin fee per month.
Yeah.
It adds up to a big number over 35 or 40 years of investment. So fees or costs associated with investment, you have introduced us to that. We will talk about that on the show.
Dr. Frank Magwegwe, as always, thank you so much for joining us this evening. We look forward to the next conversation.
Absolutely.
Dr. Frank Magwegwe is Head of Financial Wellness and Advisory at Nedbank, and he's also a GIBS faculty member, soon to be professor there.
And thank you, listeners, for tuning in to our show.